Okay, joining us now, Jeremy Siegel, professor of finance at the Wharton School. And Professor, it's always a pleasure to see you. Has your long-term bullishness dissipated at all, given the big moves that we've seen recently? Are we in for any type of multi-year period where we revert to the mean, or it's all systems go for you still?
Well, I think we're still in a bull market. I think long-term returns are not going to be as robust as they've been certainly over the last 10 years, and maybe not even over the last 200 years, but still far ahead of inflation and way, way ahead of fixed income. Right now what's going on, you've heard of this old expression on Wall Street, up a staircase and down an elevator. We're going up the staircase. I don't know when the elevator is going to come, but it looks like a momentum trade in the sense that it just keeps on going up a little bit every day. No real news to propel it, and a lot of momentum players piling on. We've had this before, it's very hard to say when it might end. Personally, I think the inflation news, not tomorrow's employment report that everyone's looking at, but the inflation news, which is coming a week from tomorrow on the PPI and then the following Tuesday on CPI, might be more important. If they blow out the numbers, the Fed is going to have to be more aggressive going forward.
Jeremy, there have been, there's been secular bulls periods, and there have been secular bear periods. And usually there's some type of mitigating factor that ushers something like that in rather than just time, whether it's maybe it could be the mistakes by the Federal Reserve. Maybe it could be fiscal mistakes or policy mistakes by Washington. Do you see that mix or a possible negative mix occurring at this point in something that might knock us off just the trajectory that we've had for the past, I don't know, I go all the way back really to the early 80s. You remember the period between 68, you remember 68 to 80, we went nowhere. We had 12 years of, I think we were lower than we were in 1981 or 82 than we were in 1968. So those things can happen. Are we in danger?
Absolutely. I mean, that was double-digit inflation that we had during that period. I think overreaction by the Federal Reserve to saying, oh, my God, we're really far behind, because I don't think the inflation news is going to moderate the way they hope. And then they start sharply raising rates, a little bit of disappointment then on the earnings. I'm not going to say that starts a secular bear market, but certainly would be something that could cause the next significant correction in equity prices.